The modern day futures market is all about price discovery. Price discovery, which speculators and hedgers are willing to establish today for price sometime after today. After today can mean 1 day, 1 month, 1 year, several years. The majority of new players hear the word futures contract or the trading in futures and become perplexed. They hear coffee futures. They hear oil futures. They hear the talk about gold futures and think, what the heck would I do with all that coffee? What would I do with all those barrels of oil? I don't even know what a troy ounce of gold is. Well, new player, we have a little secret for you. When you hear the word futures, don't think delivery, think settlement. 99% of today's future positions are cash settled, not settled through physical delivery. This means positions are adjusted in relation to price movement. Price movement just like in stocks. Settled in cash, not physical delivery. We will give the new player a brief example. Let's say through your astute fundamental analysis, you come to the conclusion there's a high probability of an increase in the price of oil over the next 6 months. You have read about global demand for oil in countries like China and India. You have read about possible supply shortages. You have analyzed the latest OPEC strategies. You, the new player, decide to attempt to capitalize on your analysis. You decide to speculate on a futures position in oil. You go long one oil futures contract which expires in 6 months. You, the new player, purchase one oil futures contract at $70 per barrel. Well, in 6 months, oil has gone up to $85 per barrel. You were right again. You have made a profit of $15 on your oil futures contract. Well, you don't need to be concerned about a tanker showing up at your local harbor and giving you a quick call to pick up your oil. Futures don't work this way unless, and we mean unless, you want them to. If for some reason you want to take physical delivery at expiration, you can do so. As a new player, you need to think settlement, not delivery. We will fill you in about the settlement procedure in a minute or two. Let's start the comprehension process by breaking down the pieces of futures. Stocks trade in shares. Futures trade in contracts. There are 4 main components to any exchange-traded futures contract: product, quantity, expiration, and price. We will get the ball rolling with product. It's pretty simple. You have to have a product. What is the financial instrument you are basing the futures contract on? In the global capital markets, futures are listed and traded on the majority of financial instruments: stocks, bonds, commodities, currency pairs, indexes, ETFs. Basically, any financial instrument can have a futures contract created off of its value. Next up, quantity. Quantity breaks down the variables of the futures contract. Quantity explains the parameters of the futures contract. Quantity will tell the players the notional value of the contract, the leverage of the contract, the expiration date of the futures contract. Next up is expiration. The majority of future contracts expire quarterly, usually the 3rd Friday of the quarterly month. However, there are also future contracts which can expire monthly. Future contract expiration date can vary at each derivative exchange or with each contract. Next up is price. The futures contract price is the current price today for price sometime after today. This is where the players speculate and hedge to where they think prices will be down the road. Prices of a futures contract can be any time after today. This can mean price discovery 3 months away, 6 months away, to several years out in time. A financial product or commodity may have futures contract priced out 3 years in time, which means 12 separate pricing contracts for one financial instrument. We now need to provide the new player with some derivative market jargon. The nearest term futures contract is called the front month contract, with any corresponding later expiring contracts deemed back month contracts. The front month futures contract is normally the most liquid contract. The majority of positions of the players are initiated on the front month contract. When a front month contract expires, the next in line back month contract becomes the new front month contract, and the process continues. The expiring of the front month contract and the listing of a new quarterly back month contract. As a new player, you need to realize future prices are constantly shifting in price. If a financial product has 12 separate futures contracts extending out over 3 years, each of those futures contracts will be priced independently. Each of those futures contracts will have a unique price level. As a new player, you are probably asking yourself, why are there so many individual quarterly futures contracts? Very good question. The players all have varying opinions to price level across all these time horizons. The players all have varying hedging and speculative objectives across various time frames. The players in the global capital markets need to hedge or speculate with positions many months and often years out in time. The banker in Amsterdam who is writing loans for various clients, these loans are not daily loans. These loans extend throughout the yield curve, from the short end of the curve all the way out to the long end of the curve. The banker will use futures to hedge the bank's risk exposure for these loans. Risk exposure 3 months out in time, 6 months out, 2 years out in time. The banker will hedge interest rates along the yield curve. Hedge today in order to eliminate interest rate uncertainty sometime after today. A multinational company which conducts business in many countries around the world must use futures to hedge currency risk. Their receivables from customers are spread out along various time horizons. 3 months out, 6 months out in time, 2 years down the road. An airline needs to budget fuel costs several years ahead. An airline cannot leave fuel prices to chance. An airline must establish fuel costs in order to price fares accordingly. An airline needs to hedge fuel costs 3 months out in time, 9 months down the road, 18 months in time. Countries of the world that are exporters of commodities. These countries make budget decisions based on being able to sell their country's commodities at established prices. They must lock in prices to eliminate uncertainty after today. whether a Middle East country which exports oil around the world, or the Ivory Coast of Africa which exports cocoa around the world, or the sugar and coffee producers in Brazil. Budget decisions are predicated on being able to facilitate commerce at a set price. A set price many months and even years out in time. Futures are about locking in price today to hedge or speculate on price uncertainty after today. We need to take a quick break and introduce the new player to another complementary aspect of any futures market. This is the spot market.